Good afternoon. Thanks for your company. My name's Jessica Amir with Bell Direct. Well, the Australian share market has put the brakes on for the third straight day as US equities have buckled at the knees for their second session amid the oil price decline on oversupply and crippled demand because of COVID-19 lockdowns. Now, at about 12:30, the Aussie share market was 0.6% lower. Most of the sectors were in sell down mode, while in a typical risk off environment, the defensive sectors continue to buck the trend, pushing higher, with healthcare up about 0.5%, with Avita Medical AVH up 6.9% and Pro Medicus PME up 2.4%. Meantime, IT stocks are also making a real run for it into the black. But firstly, three very important things to note. Firstly, the Aussie share market is now up 13% from its March lows, and that means we're no longer in a bull market. Remembering, a bull market is defined as a rise of 20% up from lows. Now, secondly, the oil price did claw back overnight, but the outlook for energy remains dim until the COVID-19 restrictions pass, and secondly, until the May production cuts come into force. But overnight, the crude oil price turned positive, trading at $13.63 a barrel, while Brent oil this time fell 23% to $19.60 a barrel. That's a price we haven't seen since 2002. Now, all this pressured equities overnight, which is why the US benchmark S&P 500 lost 3% for the second straight day, while Netflix and Chipotle rose after reporting stronger quarterly earnings, beating expectations. We saw gold rise to $1,710 an ounce, and the safe haven US dollar also rose, which of course put pressure on our Aussie dollar, taking it back to 62.93. Now, looking at the ASX leaderboard, WiseTech WTC shares up the most, about 12% earlier, after the software logistics company advised that its March quarter performed in line with expectations. Now, because of that, WiseTech has affirmed it should see its full year revenue be between $420 and $450 million. Now, that implies revenue growth of 20 to 29% on last year. Earnings will sit between $114 and $132 million, and that's growth of between 5 to 22% on last year. Pinnacle, PNI, their shares were up about 7% earlier to $3.44 after Ord Minnett upgraded the investment management firm with a price target of $6. Now, Spark Infrastructure, SPK, their shares were up about 5% earlier after they confirmed too that they should meet their earnings forecast for the year of $1.1 to $1.12 billion despite COVID-19. It also affirmed its dividend will be 25 cents per share. Now, that's a forward dividend of about 6% in terms of yield. Now, what's interesting to note is, despite Spark saying its telco services remain in hot demand in New Zealand, it's not immune to COVID-19, which is why it's now looking to reduce costs to offset the revenue impacts. Now, stocks seeing the most downside, let's call them out. NRW, NWH is their ticker, down 9.3% to $1.55. And after the market closed yesterday, there was an ASX announcement that Vinva Investment Management closed out their major holding in the mining contracting firm. Nevertheless, UBS has a 12-month price target for NWH of $4. Now, oOh!media, their shares are down 7% to 71 cents after completing that $14 million capital raise, and Stockland Group, SGP, down over 4% to $2.69 after Legg Mason closed out their major holding in the firm. Elsewhere, what are investors watching? Well, the landlord GPT was upgraded by two brokers from a neutral to a buy. So Bell Potter and UBS now have the stock as a buy, given its strong balance sheet and that its office and logistics rent makes up 57% of their portfolio. And that's more favourable, of course, than being exposed to the retail segment. And lastly, Caltex CTX, that was upgraded to a buy by Bell Potter, given the management initiatives, the cost savings, and a possible spin-off of some of their assets. Now, EPS will decline this year, however, will increase next year. The dividend yield is 3.8% for this year and likely to rise to 4.3% next year. I'm Jessica Amir from Bell Direct. Please stay safe and happy trading.